the first thing I want to talk about is some of the changes in the new tax year that you need to be aware of, and how it affects mortgage advisors. So let's head over to the whiteboard for this one, on a pre-prepared whiteboard that I've already created for you called Taxation Changes 2023-24. Now remember, if you're doing an exam, you will get what's called the tax sheet. The tax sheet is given to you in the exam, either on the screen or in paper, and all the numbers are on there. So you don't need to remember any of these numbers that I'm going to talk to you about. But if you're just keeping up to date with things, then of course a quick overview of the changes is quite useful for you. Now, of course, we're talking here about tax changes in this year. The big phrase to use now is called fiscal drag. There you go, fiscal drag. I love that phrase, don't you? It's well, it just sounds like a nightclub or something. Fiscal drag, or maybe a sports car race. I don't know where you're coming from, but the point is, fiscal drag is being used by the government now to drag more and more people into paying higher rate tax without them knowing about it. So shh, don't tell people, because in a few years' time they'll become higher rate taxpayers and didn't even know about it, because they're not increasing any of the numbers. You see, they're not increasing the allowances, and they said it's up to 2027, 28. There's an election before then, so it may change, but they're dragging people into high rate taxes by letting inflation increase their salaries, keep the bands as they are, and thus more people get dragged into paying high rate tax. Bit naughty, but they need the money to pay the bills like everybody, don't they? So what are the big changes? Well, there's three changes really. Over here I've got pensions, so let's have a quick look at the pensions changes on taxation. Over here we'll take a look at capital gains tax, CGT, and over here we'll finish off by taking a look at income tax, shall we? We'll put a little title in there for you, income tax. So pensions you've probably heard about. Let's face it, unless you've been living under a rock, you would have heard about the pension changes, because they're all quite well publicised. What's happening with a pension is that the ability for people to pay more into it has increased. Now, as you know, people pay into what's called the pot. So that's your pension pot, which is just a phrase, isn't it, that we use. It's a tax-free fund. So people pay into a pension pot. The pension grows, pays them income when they retire. And the amount you can pay into the pension has increased for the tax year, which is really good. So, if you've got a salary, you pay that in to a maximum of 60,000. So that's gone up, isn't it? So let's just squeeze that in there. So you can pay 60 grand into your pension pot if you've got a salary to prove it. No more than 60, which is great. For those people that are already taking their pension, which is a bit of an odd thing, isn't it? They can put in 10 now as well. So that's increased the amount they can pay in. So I'll put it up to that end as well. They can put 10k in each year. That's the first thing that's changed. The big change is what they call the lifetime allowance. Now, there used to be this maximum pot that somebody could accrue. It was just over £1 million, which is an awful lot of money. But if somebody had more than £1 million pot, it meant they were taxed on it when they took their pension, which is not good. So most people restricted themselves to no more than that pot. Now this lifetime allowance, as it's now called, for this tax year, it's actually at 0%. So if somebody exceeds the lifetime allowance, then they're not going to be taxed. So effectively it's not there, is it? And next year it's going to go completely. And that's the thing. So as you can appreciate, all these doctors they're applying this to, aren't they? People that have plenty of money, they can start paying more into their pension pot and grow a bigger pot. There's no restriction now to the pot, so you can have as much as you like. And when you come to retire from 55 onwards, you can take it as an income or whatever you want to do. If you've taken the income, you're taking your pension, you can still put in £10,000 per annum. That's gone up from a smaller figure as well. Now, the other thing is pension tax-free cash. Think about this. This is mortgage territory now. A lot of people still use their pension pot to pay their mortgage. So they have an interest-only mortgage. They use a pension pot to pay it off. Now, it's always been a quarter pension commencement tax lump sum. So I call it tax-free lump sum. Yeah, lump. The pension commencement lump sum it's called, but it's a quarter of the pot. Now that's actually being restricted to 25% of the old lifetime allowance, which is dead confusing, isn't it? So actually that's now restricted to £268,275, because that's a quarter of the old lifetime allowance. Just confusing, isn't it? But I don't think many people have pension-linked mortgages these days. It probably doesn't affect most mortgage brokers. So that's pension changes. Now, capital gains tax. This affects you if you're dealing with landlords, people buying second properties, holiday lets or whatever it is. And the whole point about capital gains tax is you have to pay it on those kind of properties and other assets as well. Now, the big change here is the £6,000 annual exemption. There you go. Each year you can make £6,000 worth of capital gain and not pay capital gains tax. It's gone down, it was just over 12,000 last year. They've halved it and they're going to halve it again the following year. So they're going to get rid of that, aren't they? Which the upshot of that is that more people will pay capital gains tax. Is it the nail in the coffin of sole trader landlords, people who are buying properties in their own names? Because individuals pay capital gains tax, by the way. So that might be the nail in the coffin for the individual landlord, you know, the accidental landlord, the part-time landlord, the dinner party landlord, George Osborne called them. It might be the end of those people. Because if you buy a property with an SPV, a special purpose vehicle, limited company, then there's no capital gains tax to pay because companies don't pay capital gains tax. So that might be an issue. That's capital gains tax. Changes in income tax for you. Couple of changes in income tax. As I mentioned to you, the allowances and the bands are all staying the same, which is lovely, isn't it? The one change, though, is the additional rate tax band. These are people that have to pay 45% tax, people that earn lots of money. Now, the band for that's coming down to just over 125,000, so they've reduced it from 150 to 125. And over the next few years, more and more people will get dragged into that 45% tax band for a chunk of their income, which, you know, is bad news for those people, good news for the government, of course. Again, that's fiscal drag at its very best, isn't it? Other stuff hasn't changed. That's good news. A couple of small things for you. The first one is the married couples allowance. There you go. I'm not talking about the marriage allowance. That's very different. That's one I want to show you later. The married couples allowance is an antiquated legacy allowance, just like your personal allowance, given to married couples, but only for those born before 1935. So you're talking about old dudes here. Even my dad was born 1938. He's old. But these are really old people. So if you're dealing in the later life lending market or equity release market, you may come across people of that age. What's happening here is that their allowance has gone up. It really means they get 10% tax relief. They get a little bit of tax relief on their income, which is brilliant. But the more they earn, they lose it, you see. So you've got to be careful with equity release. You don't give them income that takes them above the bands and they start to lose this married couple allowance. It's worth a couple £100 a year in tax relief, so be careful of that one. Just check out the details of that one. We've got another video on that one as well. It describes it to you. The third area is the dividend allowance. Dividends. Divs, of course, are paid to people that own their own businesses, owner directors, obviously people who own shares. Dividends are paid there as well. And this allowance is going down to £1,000. It used to be quite healthy once, but it's going down, 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 and it's almost gone, isn't it? And this will affect your owner directors who buy or take out mortgages with you. An owner director is, she runs her own limited company. It's a small company, it's only herself, maybe one other. And she pays herself a small salary to keep below the personal allowance and loads of dividends because she avoids national insurance. Legally, by the way, because the dividends that she pays herself are now getting taxed more and more now than ever before. So you might find owner directors now start to pay themselves bigger salaries and less in dividends. But their accountant, of course, will work that one out. So that's just an example of a small change. So overall then, not a lot of changes, which is rather nice, isn't it? Not a lot of changes, which is lovely in a way. So we don't need to remember too much. Remember fiscal drag though. Fiscal drag, because they haven't changed any of the allowances, is going to drag more and more people into paying high rate tax. But then if they earn it, they should pay it, shouldn't they, at the end of the day? But that's politics, and we don't talk about politics on these things, do we? But let's be useful. Bye.